Welcome to the FinTech One-on-One podcast. This is Peter Renton, chairman and co-founder of FinTech Nexus. I've been doing this show since 2013, which makes this the longest-running one-on-one interview show in all of FinTech. Thank you for joining me on this journey. If you like this podcast, you should check out our sister shows, the FinTech Blueprint with Lex Sokolin and FinTech Coffee Break with Isabel Castro, or listen to everything we produce by subscribing to the FinTech Nexus podcast channel. Before we get started, I want to remind you that FinTech Nexus is now a digital media company. We have sold our events business and are 100% focused on being the leading digital media company for FinTech. What does this mean for you? You can now engage with one of the largest FinTech communities, over 200,000 people, through a variety of digital products, webinars, in-depth white papers, podcasts, email blasts, advertising, and much more. We can create a custom program designed just for you. If you want to reach a senior FinTech audience, then please contact sales@fintechnexus.com today. Today on the show, I'm delighted to welcome Todd Schwartz. He is the CEO and founder of OppFi. And we wanted to get Todd on the show because he's one of the old guard of the FinTech lending space, founding OppFi many, many years ago now, all the way back in 2011. So we get into the founding story, which I think is unique, but we also talk about a lot about the customer that they deal with and what their options are. We talk about why he decided to come back to the CEO role. We talk about underwriting and how OppFi is able to underwrite these loans, what sort of criteria they use. And we talk about a lot of the innovations they've done, like the Turn Up program and some of the social impact companies that they work with. We talk about the banks coming to the space for small dollar loans, or we talk about dealing with consumer advocate groups and the regulatory environment, and much more. It was a fascinating discussion. Hope you enjoy the show. Welcome to the podcast, Todd.
Thank you, Peter. I'm glad to be here.
Okay, so let's kick it off by giving the listeners a little bit of background about yourself. Why don't you talk about what you've done, just some of the highlights of your career to date?
I grew up, my dad was an entrepreneur. He had bootstrapped the business in the call center space. So I kind of always had the entrepreneurial spirit as a kid, and always had jobs in the summer, was always working, trying to figure things out kind of. So after school, I went and worked for someone in the real estate space, a vertically integrated apartment developer. And then the financial crisis hit. And so I left, came to start helping my dad with some of the things he was working on. Had this experience where I had a friend who worked at a pawn shop. And this was about 2010, 2011. He invited me to lunch. Afterwards, we went to the pawn shop, and I saw a woman pawn a wedding ring off to meet her financial obligations. She was getting cash for what appeared to be a family heirloom. And so, it had a really profound effect on me. And, I just thought like, wow, like this really strikes a chord with me. It's something I think I can, I'm pretty passionate about. Like I can change how people borrow. And I had started to do some research and realized that there's a large segment of the population that's impacted by credit access for unsecured credit. Specifically, there's about 60 million people. It varies depending on cycles and the economy, but it's a large portion of the population falls below a certain FICO score. And credit historically at that time had been inaccessible or very expensive and onerous. The terms were very onerous. So, I started to do more research and saw that the banks, it was a $32 billion a year industry, NSF and overdraft fees, right? So
Right.
You had title loans, payday loans. And I said, oh my gosh, there's got to be a better way to do this. And it all started kind of with the understanding of like people's finances in their bank account, understanding their job and the security there. And so I kind of took $50,000 of my own money and opened a one-room office on the north side of Chicago and started getting referrals from the pawn shop. I was very adamant about was that we were going to help people. We were going to provide them a better option, and the product had to be fair. and had to be easy to use and easy to understand. And those were kind of the roots of and the beginning story of OppFi, the founding story of how it got going. One thing that was always important to me was I couldn't just do something that wasn't helping people or doing something or changing outcomes, right? And I liked tackling large scale problems. This was a large scale problem that I could never solve myself. We just hit 1.4 million unique customers, or 1.3, 1.4 million unique customers. So we have a lot of work to do, right? If there's 60 million total underbanked, we're making a small dent. So and then this is why I'm a big advocate of credit access, right? And credit choice and access for borrowers, because no one company is going to solve this issue, right? It's a large scale problem and a large scale issue. And I think if there's, sensible guidelines and sensible regulations, common sense ones that protect consumers, but allow for access, I'm always a big believer in that.
Right. So then maybe you could just give us a little bit of a history lesson, if you could, just kind of how OppFi has developed. And it was Op Loans originally. I've had Jared Kaplan on the show before, the former CEO, and I think have you been chairman the whole time? And maybe you can give us a little bit of the history through to the IPO.
Yeah, no, absolutely. So the first 4.5 years, I was the founder and CEO. So I ran the company, built it up, really started to get the product, the service delivery, some of the technology, and start to allow for us to lend in a centralized way, which was different. When I first started, we had branches. I had 2 branches, one in the city and one on the north side, and we were doing loans in person. I think that was instrumental in OppFi's start, though, because we really learned about the customer. I did the first 5,000 loans myself, and I actually talked to every customer, and I learned why they were using the product, why we were so much better. And we were getting a lot of referrals from friends, colleagues, and we were able to book a business with a very low cost of acquisition and a very low delinquency rate. And one of the things we were able to lower the interest cost is we took the time to underwrite the person, right? Instead of this instant approval where you just approve someone and try to charge as much as you can to cover losses, we said, hey, we can bring the rate down and offer an amortizing product, which is larger and people can pay it back in less than a year and 9 months. And it was very successful and wildly popular. And I knew that. So I would say 1.5 years in, people said, Todd, I love you, but I'd rather fax in my information or email you my documents so that you can ACH or wire the money into my account. I don't want to drive 45 minutes to the branch. And I've already met you. So I saw the writing on the wall that the world was going to where things were going to be transacted on their phone, right? And on computers. And so then I quickly started to develop and work with some vendors to develop technology to be able to lend online in a centralized format. And so once that kind of jumping off point happened and we closed the branch and I moved to the downtown office, we started to form the semblance of an operations call center and to be able to service people in a centralized format, which was much different. But a lot of the learnings from the in-store experience and servicing our customers from day one really helped me in designing our service delivery model and our best in class, customer service. And some of the social impact things that we do, still live on today with the business, like reporting credit, some of the credit education stuff. That was all stuff that was foundational in the beginning of OppFi.
That's interesting. I had no idea that you started actually with a physical office and talking to customers face to face.
Yeah, well, why I did that. I thought it was going to fail. I didn't put it on LinkedIn. I didn't. I thought this was just going to be like a charitable venture that I, helped people for a little bit, and then I wrapped it up and got back to doing, a real estate or something else. But it ended up really, kind of taking off and was really popular with customers. And I knew there was a great product market fit. That was one thing I was sure. So, what happened was I was intertwined in kind of all aspects of the business. It was very centered around me. I realized to scale this, right, to be national and to develop, we needed a management team. I needed someone. And I also have other, business interests with Schwartz Capital Group and Strand Equity Partners, where I'm a partner there. And so at the time, I was kind of straddling the fence, starting to work on both. And because the economy unthawed and there started to be other things going on. And Jared came in at a really great time, and really helped scale the business. That's when we had launched our first bank partnership and really started to scale nationally. And, as you can imagine, scaling a lending is a lot of work. So, he did a really good job working with me. I was executive chairman. So I've always been close to the business and stayed close to the business,
Mhm.
working with me and the board and management team, scaling it up and building a really good team that really continued, growth and even launched other additional bank partners where we're the vertically integrated service provider with the bank and got us into 35 states at that point. So I think COVID happened. COVID was way better than expected than almost everyone thought. I think when COVID first happened and the economy was closed, I think we all thought the worst, right? But then when the government stepped in and stimulus and the PPP started happening, I think things recovered really quickly. And credit loss is actually probably our best year on record was 2020, which is surprising
Right.
after the start when everyone thought it was going to be the worst. But that really positioned us well, right? And one thing that's funny is that never contemplated going public, never contemplated a public offering, didn't think that was really the reason. And it was a long and thought out decision. My dad, who's always been a big supporter and also, was there at the beginning when of the founding. We had a long conversation about it and, kind of weighing, it was like the old Venn diagram, right? Like public,
Mhm.
not public, the positives and the negatives. And ultimately, like, I think the structure of the SPAC merger, accelerated the timeline to go public. It's not a traditional IPO, probably takes a lot longer. And also we thought that the timing was right and we wanted to reward management and reward people that had worked really hard to get OppFi to
Right.
where it was today. So we decided to go public in July of 2021. It was a monumental day. It was pretty incredible from a one-room office on the north side of Chicago to looking up at the NYSE with OppFi
Right.
on the banner. Like it was a pretty breathtaking moment. I had my family there, and it was just something I'll never forget. But on the other side of being public, you have to be public, and so
Right.
it was a great conversation I had with Jared. He was, we decided that I was going to kind of come back into the CEO role and go more day to day. The business has changed. I mean, when you're public, it's just it's a different mindset, different business. You're not necessarily. We were a high tech, fast growing company, right? And in the public markets, there's a lot. You have to do a lot more, right? You got to be successful. And I think it took a year. I came back in and we had a little bit of a tough year last year, but really, really have found our footing. We have a really, really stable and solid team now. Some of the operating metrics of the business are back to 2019 levels, performing very nicely. And I feel like we're in a really good spot. I feel like our growth rate, we're still growing nicely, but we're also able to focus on the operating metrics, product improvements, and do other things as well. When you're growing so quickly and so fast, it's hard to focus on everything, right?
Mhm.
And I think like now we're at a really good pace and the business is really performing well. And listen, I enjoy what I do. I enjoy the great people of OppFi. Our mission has not changed since day one. We've had the same mission to expand credit access and improve people's financial health, right? I think one of the things, kind of we're going to, and is to kind of finish off the timeline is, we think that OppFi, which is the parent company of OppLoans. OppLoans still exists today. That is our core offering, which is a consumer-focused product that provides credit access in the sub 650 FICO space. It's a better alternative to other options that have been prevalent over the last 15 to 20 years. And so, that product remains today. We're still the leader in the space. It's not only the way we deliver the product, it's our product features. It's, no prepayment penalties, no originations fees, fully amortizing. We report all payments to the bureau. We have, for free, we have Experian Boost, we have Spring 4, we have all these different social impact partners that our customers get to use in conjunction with the product, no cost to them. And, we're really passionate about giving people access. We believe they should have that access, but also trying to improve their financial health along the way, right? And so that is still going strong. We still have a lot of growth there. I think, one of the challenges a little bit today is just credit in general. Like it's a little bit of an ominous outlook in the economy. No one knows, right? I've heard soft landing, I've heard recession, I've heard things are going great. So, I don't think there's a real consensus. And when you're running a public company, we're being a little cautious right now on credit and just making sure. Obviously, last year was a little bit of a tough year, so we want to make sure that we don't make the same mistake twice. And so we're being cautious on growth. But I do think, we've really done a great job at, trying to help everyone we possibly can in this environment to expand access. I think, like, if you look at OppFi though now, one of the things we're focused on is we're really good at delivering digital alternative financial service products, right? Our company's gotten really good. We have the scale, the size from a compliance and regulatory standpoint, from a marketing funnel standpoint, from a service delivery standpoint. We've gotten really good, and we built that through OppLoans over the last 10, 11 years. I think, like, there's other products in the alternative finance space that bode well for OppFi as a parent company, where we think we can do better than what's out there now, and also service it better. And so ability to take market share. Specifically, we're looking at some stuff in debt settlement, credit repair, which was very complementary to OppLoans in our offering, but also looking at small business lending. We think there's a huge addressable market there that has a pretty significant supply-demand imbalance, very similar to when I started OppFi in the consumer space. So we see a lot of similarities there. We've been, from that front, working on looking at options, understanding the market, and where we think if we did enter this space, we could play.
Right. Okay. So let's dig into underwriting for a little bit, because these are small dollar loans. There's not a whole lot of margin there. You can't have someone spending a week digging into financial statements and all that sort of thing to underwrite these people. How are you underwriting? And I appreciated sort of the way you described how it started, the face-to-face interactions. So maybe you can take like what you've learned and how you've created an underwriting model. And I presume a good chunk of this is automated, but maybe just take us through how you do that.
Yeah, no, we've worked to automate, almost 75% of applicants. By the way, there's some applicants that could go through in an automated fashion that want to call and talk to somebody, which is perfectly,
right,
acceptable. We're there to take the calls. One of the things we did early was we were focused on the bank, right, on their primary banking account, and seeing how the customer was using it, but also verifying the income through it. Their identity, stuff like that. Those are all things that other lenders were not taking steps to do. So we said, hey, like, we think we can lower the APR if we, really understand their job, the security there, and then also look at, other attributes through, some bureau information. And so what we did, we had a manual scorecard originally, right? It was a manual scorecard that we used to score it. For the first year there, it was really, hey, nice to meet you. It looks like you're employed, this and that. So but over time we started to learn and develop attributes, just develop things. I think, what's important is we're looking at it from a lens of, hey, we can't approve everybody, right? But we can always, treat people with dignity and respect, right? Maybe give them a reason as to why it's important. We think that but ultimately, like, I'd love to hear all this AI talk and all these, like, different new age underwriting. At the end of the day, I mean, let's be honest, if someone doesn't have the income to pay you to service the debt, you're not going to get a payment from that person. Delinquencies will rise. And so I think it's really, really important that you make sure in the underwriting process, ability to pay. That's something that OppFi has done since day one. It's something that is paramount in underwriting. Ultimately, that is, I mean, you can look at all these attributes, you can look at how their past behaviors, but ultimately, like, someone needs an income to support the payments for the product, right? And that's something that we've always done, and something that we continue to advocate for. Is you can spin the data any way you want it, but ultimately it does boil down to debt to income ratio, right? And that is something why mortgages have used that historically, why other lenders have used it. It's very important in the underwriting process. And it's also something from an ethical and transparency standpoint. Like, if someone can't afford it or someone's bank account is not in good standing, it's not the right thing to do. And so we still self-govern ourselves. We've been compliant with the small dollar lending rule with the CFPB since it was written, and continue to think things like that, like ability to pay, making sure income verification, bank account verification. Those are all common sense guardrails for consumers that we support.
Right. Okay, so I want to talk about this program you have. I think is somewhat unique. That you're a turn-up program. It's not a turn-down program. Explain a little bit about that. What was the thinking there? How many customers are you referring out?
It's something that, came about probably five years ago or so. We kind of were sitting around a table, and how it came about was, hey, like, one promise to our customers or new customers is, hey, when you come to us, if we can find you a lower rate product that you may qualify for and you're just not aware of, we should extend that to you, or have that technology in place to offer that to you to see if you can get a lower cost product other than ours. And so what happens when customers come to us directly, we will screen them against a consortium of lower cost lenders, and they could potentially match. Obviously, once they match, then they have to go through the underwriting process of that lender. However, we have usually about 10 to 11% of applicants match. And I think probably a third of those get approved. So it's still pretty low, like when it comes to like how many people do qualify, and that shows that they're definitely, if 97% of the customers don't get approved, that means that we need to be there on the back end if it doesn't work out. But it's just something that we think is the right thing to do, and a lot of times people don't realize they qualify maybe for a lower rate product, and so if we can extend that to someone and help them facilitate that, we think it's good business, right? And we think that people will appreciate it in the long run. And so regardless, we don't get the customer, but it's okay. We're okay with that, because it is our mission, and what we set out to do is help people get financial access and better financial access.
Yeah, you started this obviously over a decade ago now, I think. And in that, when you started, there was no banks offering these products. It was pretty much no large banks, shall we say. Now you've got US banks had a product for many years. You've got Wells Fargo, B of A, you've got Truist. So you see more and more banks entering into this small dollar space. And obviously you got a little bit more clarity from the CFPB on that, which has helped. But why do you think we're seeing more banks entering the space, and what impact's that having? Is that a positive or a negative impact on your business?
All in all, like, I think the banks have pretty stringent, application requirements to get those products. Like, you have 6 months with the bank, you have to have stable income, all this kind of same underwriting to even achieve. And some of them are higher rate, right? But we're supportive of it. I mean, ultimately, like, if someone can get a better product that fits their needs and prevents them from kind of the financial spiral that can happen from an unexpected emergency expense or being short of cash flow, I think it's a good thing. One of the things about some of these products, though, we've always stated our APR straight out. Like, we don't charge our origination fee, we don't charge prepayment fee, no late fees. So instead of doing that, which you could also always state a lower rate and then charge fees, right? Like the Spirit Airlines model.
Right.
We don't do that, and so people should just understand what the true cost of those products is, right? The APR may be stated in a way, but if there's fees and things, what is the APR actually for what you're getting? And I do encourage, consumers to understand that. But yeah, I mean, ultimately the banks, participating in the space will help, number one, lower overdraft and NSF fees, but also provide more access, right? And I think there's plenty of room for banks to play in that and still us coexist. I'm not, from a demand perspective, I think I'm supportive of it.
Right. So you mentioned the demand perspective. So I want to touch on the consumer advocates who dislike small dollar loans. Many of them want to just completely ban it, but the reality is the demand is not going to go away if you ban these types of products. What are these consumer advocates who dislike your product? What do they not understand about your customers?
Yeah, I mean, number one is, our customers are gainfully employed, right? Their knowledge of consumer finance, what they can afford as payments, how much it's going to cost. I mean, number one, not only does our contract clearly state all that, they know, they understand. I think I challenge if people are like, oh, people are, being taken advantage of, this and that. They're not. These people understand what they're doing. The problem is they don't have options. They don't have options, right? So if a mom of 3 kids brakes blow out on a Thursday, right, and the car has to go into the repair shop and it's $800 out of warranty break, and she doesn't have that cash flow to support that. there needs to be options out there for people to fix that, so that she can fix her car on Friday and then Saturday, Sunday drive her kids to activities and then Monday go to work again, right? If you can really start a very severe spiral of someone's financial situation if those options are not out there. When you look at our product, one of the things everyone's focused on APR is like the what everyone talks about. But you really need to look at the totality or the whole product in general. If there's no prepayment penalties, no origination fees, like ability to pay, right, all the product benefits like reporting to all three payment bureaus, like they just focus on one variable of five in a product set, right? And APR is always the one that is talked about almost exclusively. But it's like, yeah, I can lower my APR to have, and they'll say that's what you should be doing, but then I can charge fees on top. And so it's one of those things. It's like, I'd rather just state the APR the way it is. And the truth is small dollar lending, less than a year, which is what we do, right? We have the blueprint for what a small dollar lending rule should look like. It should have everything that we're doing, ability to pay. They should report to the payment bureaus, no prepayment penalties, right? Simple daily interest, fully amortizing. So what happens is there's bad actors, right, that in this space probably take advantage, and we all get grouped together, which is not fair. I think you do need to look at the provider, right, and you need to look at what they're actually offering and how they've helped customers. Not just regulate, one size fits all, right? And so we are a big advocate of consumer protections. We think that these are common sense and that there needs to be guardrails for this. But we do think in small dollar lending, ability to flex on APR to cover cost and expenses and have on-demand service for people like we do, you need to be able to do it profitably. And every time that there's some type of rate cap or a ban on banks working with fintech partners like ourselves in a state, we see the data afterwards, and the unintended consequences are dire for people that have below a 650 FICO score. Banks do not come in and magically lend. Other lenders don't come in and start magically lending unprofitably. No, nobody's going to do that if it's not profitable, and they're a for-profit company, right? They're not going to be able to fill the void. So what we've seen, most recently, like in Illinois, is we've seen that customers are impacted very negatively, right? They get behind on bills. They're not able to keep up. They're going across state lines for payday loans. They're getting tribal loans online at 400% APRs. So, and most customers that we talk to were like, hey, we wish you were still here. They took away this option from us because they did a one size fits all regulation that knocked everybody out. And so listen, we're not going to be able to prevent all that from every time from happening. But one thing we do is we like to sit down and have conversations with regulators in states and lawmakers in states, and just tell them about what the situation is, why customers like Opp loans, how they're using the product, how we're responsible and how we administer and deliver the product, and try to help they understand from our point of view. And a lot of times we have a lot of success when we actually sit down and talk about it and help them understand why, hey, we're not charging fees up front, so there does need to be, and someone could pay off in 2 days, so we would actually lose money on that. That's why we just state a higher APR to be able to cover costs. It's literally that. It's not that we're not a 40% margin business, net income margin business. We're below 10%. So you need ability to flex on rate to be able to make this happen and provide access for people kind of on demand in real time.
Right. So then you haven't chosen an easy business when it comes to dealing with regulators. You just said that, when you're able to sit down face to face with regulators, oftentimes they can really understand where you're coming from. But I'm thinking about nationally. Is there any kind of are you focusing nationally to see if there's some sort of federal regulation that can really come through to help your types of customers and your products be viable nationwide, or are you really focusing on the states?
Yeah, I mean, right now, because of the Senate and the House are pretty, deadlocked, right? There's narrow margin for the Democrats in the Senate, and the Republicans have the House. There's not much talk about, a bipartisan effort for a small dollar lending bill right now. So most of the interactions come at the state level right now. that's kind of today's environment. But every time there's an election, right, a presidential election, which is coming next year, things change, right? And so we kind of respond to what we see and kind of our strategy there to inform people about our business and how we try to help people. Right now, it's mostly at the state levels where we've been really working with states. This past midterm, a lot of new Congress people and the state legislators came in. A lot of new state senators came in. So, the new class, we try to explain to them, hey, this is how many constituents in your state need or use this product. This is how OppFi services it. We think this is best in class for these reasons. And, we'd appreciate, just knowing that one size doesn't fit all, and APR is not the best metric necessarily to regulate this product, right? It just cuts off access in the end. I think one of the things I do that's probably more talked about in today is affordable housing, right? You almost hear about affordable housing on a weekly basis. Mm-hmm. And very similarly, it's an issue of there's not enough supply, right? Like we all know that the only way to lower housing costs is to have more supply, right? And it's kind of basic economics. Rent control doesn't work. Like I haven't seen it work. If someone could point a case to me where it works, I just haven't seen it. It's similar to rate cap. A rate cap doesn't work, right? It doesn't deal, you said this earlier, with the demand. The demand stays the same. People still need the product, just like people still need affordable housing, right? So there's other methods, right, that work, that put protections, guardrails, protect the vulnerable, but also provide access to the people that need it, whether it's housing, whether it's credit. But I do believe choice and access is what brings down prices ultimately, right? Competition, not banning some things. That never really seems to work.
Right. Gotcha. You mentioned social impact as a really important part of what you guys do. And can you just maybe take us through, 'cause one of the things that I've always been a supporter of products like this, even though many people say 36% rate cap, we gotta, that's sort of the gold standard. They're missing out on a huge segment of the population that simply can't be underwritten for that kind of price. So what people I think are concerned about in general is a debt spiral and people just taking out a loan and then just never being able to pay it back and ended up just spiraling down into bankruptcy. How are you making sure that doesn't happen for customers of OppFi?
Yeah, I mean, there's a couple of things we offer to our customer at no cost. Social impact partners, Spring Forward, there's Experience Boost, and those are Spring Forward connects people with local communities and helps them with resources and provides them that option. Experience Boost helps boost people's credit score. A lot of times people have reporting on their credit that may be impacting it, and it tells you kind of easy steps to remove those trade lines to provide for potentially a score increase, which can help you get lower cost of capital. We report all three bureaus every payment, so people can get a positive trade line and show that they're responsible. So the turn up program, right, is a big one. We're trying to get people lower cost of capital, right? That's a commitment to our customers. So I mean, those are things that we do that's different than kind of most. We also have OppU, which is a personal finance credit education site that we maintain and write articles for. And so yeah, I mean, we've done some of that. We just launched a credit education tool where people can win gift cards for playing games about credit education. And so, we're kind of in the forefront of finding ways for people to learn while they're using our product and to help, make their lives better in that respect. I think one of the things also that I always talk about is, personal finance is not taught in schools. It's starting to you're starting to see state legislators pass laws that it's required, like health education and personal finance education are required. I think I'm always a big believer in it. I think it's not talked about enough. And what happens is people kind of come out of college and, they don't really understand how to use a credit card responsibly. They don't understand, interest rate, amortization, the different financial products. It's confusing, especially if it wasn't taught to you at a young age or your parents really didn't kind of bring it into the household. So I think that's something that is really important for kids to learn this at a young age about managing money, about the different financial products, what's beneficial, what's not. and how to use it responsibly, I think is really important.
Okay, so last question. You've been a public company now for more than 2 years, and just love to get a sense of how that's changed, how you do business, how it's changed sort of the employee kind of feelings inside the company. What's different now that you're a public company?
One of the things is it's made us better, right? We now have, oversight by the SEC. When you're in the spotlight like OppFi is, we make sure we operate at the highest level of standard to make sure that the company's fulfilling its mission, but also, doing it from a compliant standpoint. And, I think we've gotten good. You have SOX, you have SEC, you got a lot of requirements now that, ultimately, yes, some of them are tough at being a smaller size company that's less than $1 billion market cap, kind of have the same requirements as a larger company, so that we don't have the size necessarily or the balance sheet to spread the cost. But it does make you better, right? It prepares you and makes you better, so that we're continuing to do things at the highest standards and levels. I think one of the things I've learned about that reporting every quarter is tough, right? So in the private markets, you don't even have thoughts when you're operating. You're like, hey, let's go invest these dollars, now, and test this and make this happen. But when you have this, when you have investors and when you have the street and you have financial expectations, right, you have to learn how to do it in those confines, right? You can't kind of move as quickly necessarily as you want, but we're still able, we haven't lost our competitive and entrepreneurial spirit at OppFi. I mean, people, we still like to keep things nimble and always be testing things and make sure that we're, staying in the forefront, right, of our service delivery and also our productization. And so, it took us, it probably took a year, right, to learn how to be public and just learn what that means to be public. But I think we're in a really good working rhythm, and I think the company's responded really well. We had a kind of muted profitability last year, but, kind of came out in the second quarter, and a lot of the things we did, from improving the payment portal experience to the underwriting model to our marketing funnel, we improved major metrics of the business significantly year over year, and a lot of that was the hard work of the team at OppFi, and us just kind of getting back to the basics, right, and really just saying, hey, we're public, but that doesn't matter. What got us here, we need to keep doing, right? Just because the lights are brighter, just because our stock trades publicly every day, every market day, it doesn't mean that the economics or what we've been doing in the business has changed. All that remains the same, right? We still got to be driving value to our customers and still fulfilling our mission. That's how we got here. That's what we have to do to continue to go on. So I think it's more normal now. It was very fast paced, exciting. It was a lot of new stuff for our team, in the first year. But I think we're starting to become more normal, and the pace of change and learning is slowing down, which is good. So we can get back to doing what we do well, which is provide credit access.
Okay, we'll have to leave it there, Todd. Great to have you on the show. Thanks for coming on, and best of luck to you.
Peter, thank you. I enjoyed meeting with you, and thank you very much for having me on.
Well, I hope you enjoyed the show. Thank you so much for listening. Please go ahead and give the show a review on the podcast platform of your choice, and go tell your friends and colleagues about it. Anyway, on that note, I will sign off. I very much appreciate you listening, and I'll catch you next time. Bye.